Ladies and gentlemen, good day and welcome to the Corporate Speaker Access Conference Call with the management of KHADIM India Limited to discuss their Q2 FY21 results hosted by Reliance Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankit Merchant, Research Analyst from Reliance Securities. Thank you and over to you, sir.
Thank you, Lisa. Hello and good evening, everyone. Welcome to Q2 FY21 earnings conference call of KHADIM India Limited. We have with us management of KHADIM, which is represented by Mr. Siddharth Roy Burman, Chairman and Managing Director, Ms. Namrata Chotrani, CEO, and Mr. Gaurav Goenka, AGM, Accounts and Commercials. I now hand over the call to Mr. Siddharth Roy Burman. Over to you, sir.
Namaskar and happy Diwali to all of you. Good afternoon, everyone. We welcome you to this conference call to discuss the company's performance for second quarter of the financial year 2021. We realize most of you have connected to this call from your home and hope all are keeping safe. The COVID-19 pandemic has had an unforeseen impact on people, communities, businesses, and the world at large. We take a moment to salute the heroic effort of healthcare workers, frontline staff, and researchers working around the clock. Over the last quarter, we saw the lockdown slowly being lifted across the country, which did show an improvement in performance in last quarter. The customer buying behavior was driven towards open sandals and low-price essential products for homeware. Our initiative to take our products to customer on the go hotspots and KHADIM's near me have yielded dual benefits of generating sales as well spreading brand awareness. Since Durga Puja, the annual mega festival in the East, we had special social media campaigns with exclusive videos with the underlying message of Ebar Puja Just KHADIM to increase engagement with our customer base, which eventually enjoyed millions of viewers. As we mentioned on the last con call, we saw a good growth in the distribution business. One of our strategic initiatives in this business to spur the growth was to launch exclusive sub-brands. We now have 5 sub-brands in the distribution segment focused on different merchandise categories. The demand for open footwear has been steadily increasing in the recent months. Our new revamped line of product with fresh, trending design has been welcomed by both the seller and customer alike. Coming to our financial performance, we recorded a revenue of rupees 121.70 crore in
Ladies and gentlemen, the line for the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, sir.
Okay, sorry, the line was disconnected. So, coming to our financial performance, we recorded a revenue of rupees 121.7 crore in Q2 FY21, down by 45% year to year due to the limited scale of operations. However, on Q2Q basis, a growth of 101.6% recorded over the sales of rupees 60.4 crore in Q1 F21. While the retail business suffered due to lockdown on some stores across states, the revenue from distribution segment registered a 13% growth year to year and also saw improvement margin. Gross margin for the quarter stood at 39.4% in retail and 29.6% in distribution. We look forward to steadily increase scale of operations as more stores open up and we inches closer towards normalcy. As a team, we are united and optimistic to face the challenges while benefiting from the opportunities. Our team spirit and Indian culture binds us to understand the business environment and emerge stronger. We are excited for the next phase and will continue to strengthen our brand. With that, let's start with question and answer. Thank you very much.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepan Shankar from Trustline PMS. Please go ahead.
Good evening, everyone, and thanks a lot for the opportunity. First of all, I just wanted to understand, despite we have seen 3 times QOQ sales growth in retail division, what is the main reason for drop in gross margin 500 basis points to 39.4%?
Mr. Shankar, thanks for your question. So I think on the retail side, there have been a couple of things that have happened. Number one, the number of people buying, the low price products, which is basically your Hawaii chappals, your beach sandals, floaters, which people use at home or just basics to go out. That is what has sold more, which has contributed to lowering the ASP as well, and also impacted the gross margins to that effect. That's number one. Number two, because we have, in Bengal and the east and, and the northeast, Chaitra sale is very huge in March and April. So when the lockdown was announced, we were actually anticipating, or we were just about to start the Chaitra sale, which would have helped us liquidate a decent amount of our slow non-moving inventory, which we generally, pile up so that we can offer it in the EOSS. This stock, which we were not able to liquidate then, we have ensured that there is a silent discount that is happening in stores so as to liquidate that stock. And also it helps because the customers today are looking at very low price products. So from the customer standpoint also, they have the option of buying discounted items, which has also impacted discount. Which has also impacted the gross margin. The third thing which we've also done is because the volumes were low and just to entice the customers to come to the stores and buy more and to increase the average billing value, we were also offering schemes, which is like the Milega Much More scheme or a gift scheme or a product-based scheme. Like for example, sometime in August we had come up with a scheme where on a purchase of 1,000 rupees you get a ladies footwear free, a ladies sports shoe free, and on a purchase of 1,500 you get a men's sports shoe free. So that also impacted gross margin. So generally what we do is we have either a discount or a scheme are not both together, but in some of the months, just to encourage people to buy more and just to entice average billing value, higher average billing value, we had given a scheme and a discount together, which has little impacted the gross margin, which in the next few months we will reduce.
Okay. So can you please highlight the kind of drop in ASP as compared for the current quarter as compared to last year, and also if you pulled out the discounts offered, so that will also be helpful to normalize the sales trend.
Sorry, can you repeat your last question?
Yeah. Also the discounts offered over in the top line, so that will help us to normalize the current quarter sales as to compare it with the previous year sales.
So I think the ASPs have fallen by around 10 to 12%, and in the second quarter. And in terms of discount, generally we have landed with discount as a percent of sales of approximately 20-odd%.
20-odd%. Okay. And so in terms of retail outlook, so now we have two scenarios. Like one, the top line going up quarter on quarter, and also along with the gross margin improvement. So when are we expecting the last year sales to achieve in the similar levels, at least in FY22?
So I think this year, the festive has brought in a big cheer in terms of numbers. As you'd be hearing in the retail, outlook, we had seen last month and even to an extent this month, that we had seen the degrowth or the recovery almost at 70%, the degrowth being around 30%. And that is something which the degrowth is something which we are seeing reducing. And we are hopeful, I think that's the endeavor, that we are able to achieve last year numbers, at least last year's numbers for the second half, at least we are hoping to achieve that this year. That's the endeavor at least. In terms of the full year sales, it will not be possible to recover the entire last year sales this year, but I think we are hopeful that we are able to do that the next year.
Okay. So we are expecting the improved footfall to continue even after festival season.
That's the hope. All our fingers are crossed. We're also trying to come up with innovative schemes or some kind of interesting mechanisms to garner footfall. That's something which we have to do. But it also depends on how the COVID comes around. If there's a second wave that comes in, that definitely will reduce the momentum. But we are hopeful for the best.
Okay. And finally, other expenses have jumped sharply, even Q1Q. So is there increased ad expenditure was part of other expenses or any other reason?
In fact, other expenses has reduced. We have reduced expenses.
No, Q1Q I'm asking.
No. That's basically because in the first quarter there was a reduction in a lot of aspects, including rent, including fixed costs, including the factory. So that has be it the infrastructure cost, electricity, fuel. So I think that around Q2 over Q1 there will definitely be an increase, and that does not include advertising. There has been a strict constraint on the advertising cost, which is for sure.
Okay, so ad cost remaining same to the level of Q1.
Yeah, pretty much. That's pretty much. Yeah.
Okay. Thanks a lot. I'll come back in the queue. Thanks a lot.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ankit Merchant from Reliance Securities. Please go ahead.
Thank you for the opportunity. The first question is related to the festive sales. Can you give us any color on how the festive sales were for us during the last 15 to 20 days coming in from Durga Puja to till at least Diwali?
So as I said, firstly, thanks, Ankit, for your question. Appreciate your interest. So I think, as I mentioned earlier, there has been a good recovery since Q2. We have been able to, reach a recovery of 70%, which in turn connotates a degrowth of around 30%. So I think we are looking at an improved footfall, improved average billing value to an extent, and improved ASP compared to Q2. So I think that definitely has brought in cheer for us internally. The numbers are healthy. Definitely not. We've not still reached last year numbers, but we are hopeful that gradually, once people develop a herd immunity, once the fear reduces, I think people will be coming out and buying more, and that's the endeavor and that's the hope for the next couple of months.
My second question is related to the fixed cost reduction. Can you help us understand what are the measures which have been taken, and also on the rent renegotiation for all the outlets, etc. What are measures have been taken, and how long will those be?
Yeah. So on the fixed cost, so there has been a reduction of approximately 18% in the personnel cost, 32% on the power and fuel, around 15% on rent, 21% on repairs and maintenance, and so on and so forth. So I think on the freight and delivery being a variable cost, there is significant reduction owing to reduction in sales. So I think there have been significant measures taken in the cost reduction. In terms of the cost reduction exercise or the rent reduction, around out of 200 stores, around 160, 170 stores we have been able to reach negotiation in terms of rent reduction. The balance is also on. Given that the rent negotiation is also a function of performance and their relationship with the landlord. So I think that does continue. It's not stopped. So I think it's as and when we get some sanity or get some comfort around the fact that the revenue or the sales will not drop further, which is when the negotiations will stop.
And just another bookkeeping sort of a question. At what top line would we be breaking even on the EBITDA front?
Around 550-600 crores.
Okay, that's on the yearly top line front, right?
Yes.
Okay, so till now we have done close to 182 crores. So can we expect in the second half that we would be turning EBITDA breaking even? I mean, or coming to that run rate of 500 or 5 to 600 crores on the top line front?
Yeah, that's the endeavor. Yes.
So then we need to be target a very quite aggressive growth from here on in the second half. So you think there are enough levers for us to grow in the market?
Yeah, so I think we're looking at, compared to last year, we're looking at achieving similar numbers at least for the second half of this year. So I think that number was, I think 500-600 crores is PBT break even. So the EBITDA break even will be around 450-500 crores. So I think we'll be able to reach that. Hopefully, we'll be able to reach that number by the end of the year.
Sure.
In terms of that rate.
Sure. I'll come back in the queue for more questions. Thank you.
Sorry?
I'll come back in the queue for more questions. Thank you.
Thank you.
Thank you. The next question is from the line of Harsh Yogesh Shah from B&K Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. My question is on the distribution business. Can you explain? We've recorded stellar growth of 13%. Can you explain the reasons why we've been able to achieve this growth?
Sorry, can you repeat your question? I didn't hear you.
My question is on the distribution business, which saw 13% growth.
Yeah.
So last quarter we had mentioned that, there have been some north-based players which were not being able to open up on time. So is that the only reason why we've been able to clock such good growth in distribution business?
No, so I think it's a function of two things. Number one, yes, we did get a first mover advantage like most of the branded players in the country, that, where a lot of the smaller players and mid-sized players were not able to open shop as fast, and which is why we were able to, sell much more in terms of, our production. Second point that, is that the demand for low-price products, majority being Hawaii, increased quite drastically, because a lot of people, be it in the rural areas, even semi-urban areas, even in the urban areas, were staying much more at home, or being just in the locality, which increased the demand for Hawaii chappals or low-price products, which did increase the demand for even KHADIM products, and which is why we saw that kind of growth.
Okay. So, do we see such kind of growth, going ahead, or do we see the growth to even improve from this level?
So we are hoping for the growth to continue, and even Q3 at least seems to be going in that direction. And our endeavors will be to ensure that we'll try at least that we are able to recover whatever losses in April, and continue the growth of the year.
Okay, thank you.
Thank you.
Thank you. The next question is on the line of Aditya Bapat from Equintus PMS. Please go ahead.
Hi, thanks a lot for the opportunity. My question is a bit long-term in nature. Now that you're seeing a lot of adoption of online sales due to the pandemic, do you see a change in the way your stores are, sort of the format of the stores or the area of the stores or something like that? Do you see a change in that going ahead? And how willing are your franchisee owners, willing or unwilling, to adopt the omni-channel?
Thanks, Aditya, for your question. So I think, in terms of store economics, we believe that, generally we have been in the range of 1,000 square feet overall, with a 70-30 ratio in terms of selling area. And that generally has worked well for us in terms of store economics, break-even, and ROI. And I think in terms of the franchisees, a little bit lower, from just to ensure that they are able to get the ROI and payback as well. And I don't see that really changing or impacting the way, based on the way e-commerce and omni-channel is shaping up. In our mind, at least internally, we should, the idea of having this kind of stores, this size of stores helps us, ensure a good revenue per square feet and also gross margin per square feet. Larger the area, you tend to increase the number of SKUs and inventory, and not necessarily generate the kind of gross margin per square feet that one would like. In terms of servicing omni-channel orders, through your stores, if that's what also you are trying to get at, we've had conversations with a lot of omni-channel agencies. In fact, we have omnified most of our stores. The customer walks into the store and they do not find a footwear of their choice of color or size, the product is delivered to them. Servicing of the orders from our own website, from a couple of marketplaces also done from our own stores. But they do not necessitate that the stores act like warehouses. They use the inventory of the stores the way it is. We do not need to increase the inventory of the stores to service these orders. The way it works is that suppose today an order is placed, the order goes to one store. If the order is not there, the product is not there at that store, then the order hops on to the nearest possible store where the product is. So it does not necessitate for us to have a larger number of larger stock to service those orders, because eventually if the stock is not there at any of the stores, it goes to the warehouse. So I hope I'm able to answer your question there.
Yeah, absolutely.
And can you repeat your second question if you don't mind?
No, those were my questions actually.
Okay, great. Thanks.
Yeah. So, okay. Thanks a lot. I'll get back in the queue.
Thank you. The next question is from the line of Jainesh Chheda from Dimensional Fund Advisors. Please go ahead.
Good evening, ma'am. A couple of questions. Number one, what will be your current working capital days and the breakup in terms of your retail working capital cycle and distribution working capital cycle? And number two, what has been the trend in the e-commerce sales and how has it performed YOY and QOQ basis?
Thanks, Janish, for your question. So I think, to give you a number, a day answer in terms of days may not be appropriate because the numbers will be very skewed because of the lower base in terms of sale numbers. But one thing I can definitely tell you is that the working capital has definitely improved from last September and to an extent also from March. So if you see that, our inventory today stands at approximately, as on September was almost at 160 vis-a-vis 200 odd crores last year. 100 at around the debtors were almost 100 crores versus 190 last year. And creditors situation also has improved. So I think in terms of working capital, we are in a much better position. And in terms of your second question regarding e-commerce, so we have last year sometime we were approximately at less than 1% in terms of net sales in H1. We have reached approximately 2.5 to 3%. This H1 this year. So we are seeing an improvement in e-commerce sales, and we are also working very hard on trying to omnify the entire sales along with all the marketplaces and our own platforms. So hopefully we should see an improvement from here.
Okay. And in e-com, what are the margins that you make net to the company after all the commissions and transportation charges and all?
I'll give you that number offline, yeah.
Oh, that's sure. Thank you. That's all from my side.
Thank you.
Should we move on to the next question?
Yes, sure.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Devendra Pandey from DP Advisory Services. Please go ahead.
Hi, good evening, and thanks for taking my question. So I have a couple of questions. My first question is on your overall working capital days and inventory days, which is obvious that would be stretched for H1 FY21. So how should we look at those numbers for the second half and for FY22?
So in terms of second half, the endeavor for us is to continue at the same level. I don't think we're looking at increasing the working capital. The teams, be it on with regard to the debtors, the teams are working extremely hard to ensure that we are recovering the past debts a little more aggressively, and we're also trying to ensure that we're coming up with a policy to so that the debtors remain the same level. In terms of inventory as well, we are working on the back end and in terms of liquidating the slow-moving inventory on a very, very aggressive basis. So I don't think we are looking at increasing the working capital cycle for this year. For the next year, I think on the retail side, we're looking at approximately 75 to 80 days in terms of net working capital cycle, and around 2.5 to 3 months. And in terms of distribution, we're looking at around around 1.5 to 2 months in terms of net working capital cycle.
Okay. And my other question is on a YOY basis, the gross margins in the distribution business, it has increased, but EBITDA margins have reduced. So can you throw some light on that, some outlook maybe?
The thing is that the gross margins, to be fair, have improved, owing to two main reasons. One, there has been an increase in, there has been some price increase that had been taken pre and post lockdown, and and that has definitely helped them improving the gross margin. The EBITDA margin has been, so I think the way the corporate cost is allocated is basically generally based on the quantum of gross margin contribution from each of the businesses. Given that the distribution margin contribution in terms of absolute gross margin has increased this year, that's why the corporate cost allocation has increased there, which is giving a skewed number. Which is why it would not be appropriate to see the numbers right now. I think in the next couple of quarters, it'll give you a better picture.
Okay, and my last question is on your average realization per piece. So, are you expecting that to improve or remain at the similar level for FY22? And if we are expecting average realization to increase, then what kind of strategy we have undertaken to increase the realization?
So, I'll answer you this question in two parts. One is on the retail and one is distribution. On the retail side, I think we have worked on improving the entire range architecture and the product, so as to ensure that we have an improvisation in product mix towards your sub-brands, so that which helps us increase the ASP. And there have also been some level of price increases taken in this year. As I mentioned earlier, the ASPs have been negatively impacted owing to 2-3 reasons. One, people buying lower price, preferring to buy lower price footwear this year. Silent discount being offered so that the customers have the option of buying more discounted footwear this year. And third, we have also been giving retail schemes. This impact, we are seeing this impact slowly wearing off. In the third quarter, we should see the impact on the ASP better, I think, compared to the last couple of quarters. Whether it will increase or it will decrease is a bit premature for us to tell you right now, but I am quite confident that the team is quite confident that in the foreseeable future, that is maybe the fourth quarter or the first quarter next year, you will see an increase in ASP on the retail side. On the distribution side, what we're also doing is, we are working very hard on trying to increase the number of the sale of the non-Hawaii PVC and EVA business, which is more focused on, sports and PU, basically the footwear business, and which will help us increase our ASP. And we also simultaneously we've taken some price increases to, to ensure that we are able to recover some of the cost increases that we are anticipating. So the ASP is hopefully expected to improve in the next couple of quarters.
Thanks. That was really helpful. And I will join the queue if I have any further questions.
Thank you so much.
Thank you. Reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ankit Merchant from Reliance Securities. Please go ahead.
Yeah, thank you again for the opportunity. So my question is related to the debt levels. Can you share some highlights on the debt front and how do we see our debt going ahead?
So I think we, in terms of our limits, utilization is relatively on the lower side, and I think we are looking at, we don't intend to increase our debt levels for sure. Our endeavor is to, increase, to reduce the debt through internal cash flows and improved, improved working capital cycles.
Sure. And suppose if we have to do, over the next 2 to 3 years, if we have to touch a top line of close to 1,000 or 1,200 crores. Okay, so what is the sort of capex which we would be requiring going ahead, and how many store expansion can we see if suppose the growth comes back to the normalcy and if at all we have to touch that figure in next 2 to 3 years?
I think I can give you this. I can answer you this question offline. Yeah.
Yeah. Okay.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is on the line of Deepan Shankar from Trustline PMS. Please go ahead.
Yeah, thanks a lot for the opportunity again. Just wanted to check whether the franchisee stores performance, how has been the performance during last 2 quarters, and are we seeing improvement over the next 2 quarters?
Thanks, Shankar, for your question again. So I think the franchisees are majority of the franchisees are actually located in the tier 2 and tier 3 markets. And in general, we have seen the performance of the stores in those markets better than the stores in the metros, purely because, the impact of the COVID and also the lockdowns was relatively lesser on the inside than, in the metros. And because of that, the secondary sales performance in many cases for our franchisees is better than our CEOs, because many of our CEOs are there in the metros and mini metros and tier 1. So on a relative basis, the performance of the franchisees has been better.
Okay. So are we expecting some primary sales increase over next 2 quarters during second half because secondary is doing well in franchisee?
We are seeing a decent trend as of now.
Okay. And also a trend on these fixed expenses. So full year, are we expecting some 20% decline over past year?
Around 20% is overall basis.
20% is possible. Okay. Thank you and all the best.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. As there are no further questions, I now hand the conference over to Mr. Ankit Merchant for his closing comments.
Thank you. On behalf of Reliance Securities, we would like to thank the management for taking our time and guiding us on the prospects of the company. And we wish the management all the best for the coming second half of the Q1 of FY21. And thank you so much for joining.
Thank you all for joining the investor call, and I really appreciate your interest and your patience, and look forward to being in constant touch with all of you. Thank you.
Thank you. Ladies and gentlemen, on behalf of Reliance Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.